Hi, Lindsay Mignano here, Mignano Law Group. I'm so happy to have Jason Galick, our tax lawyer, with us. One of the things that we do here at the firm is M&A, and we usually are sell side, although sometimes we are buy side. The majority of times that we are sell side, we represent small businesses or technology companies that are selling to either big tech, big co, or in some combination of a private equity funded big tech, big co sort of transaction. And the founders, they could be first time founders who have never had an exit before. Sometimes they don't know to reach out to us in advance of receiving the acquisition term sheet. They might be having conversations with their venture investors about getting acquired. They may be having conversations with their friends and family about getting acquired, but they don't always reach out to lawyers right away. And they usually come to us when they're like about 99.9% sure that they are going to get acquired and there's a term sheet on the horizon for us to review. That can be a mistake because there's quite a lot of tax planning that can be done on the individual and corporate end beforehand to maximize tax efficiency. And while I am not the tax lawyer at our firm, we send folks to Jason Galick because he helps both individual and companies approach those sorts of events. So Jason, we talked earlier, just the two of us, about Section 382. Can you tell the audience more about what that's like?
Yes, thank you, Lindsay. 382 is a limiting statute for net operating losses. And how this impacts startups in particular is generally, not always, but most of the time, startups are going to have financing or just money, cash flow problems and difficulties. And those generally will turn into net operating losses. The problem is if you don't plan for this and you later sell or are acquired by another company, if you don't take steps before that point, you could severely reduce or limit the amount of the net operating loss that you're able to use going after that point. And just to kind of back up a little bit, net operating loss is when you have more expenses than income for any given year. And that is a loss that is deductible and it carries forward until you use it. And one of the things that 382 does is it limits it to an extent where you won't be able to use most of it potentially. So if you have a very large NOLs, the limitation, if it applies, then you're going to have a limited use of that net operating loss going forward. And that might not seem like a lot, but in the future, when you're actually profitable, it's going to make a big impact potentially. And it could really interrupt your bottom line because it's tax savings that you generated while you were developing and growing. And once you're profitable and established, you essentially lose that if you're not careful. So that's really the important part of 382, among many others. But this is one that I think in particular affects startups and businesses that are just starting across the board.
And I guess here's the question that everyone's going to wonder is, when do I talk to you about this? Now, is that before the term sheet? And if so, when? 6 months before, 12 months before? If I'm a startup that's just anticipating possibly getting acquired as opposed to going to my next round, what's the best time to loop someone like you in?
So generally as soon as possible. If you don't have tax counsel available, if you have a CPA could even offer some guidance, but you really need to involve your tax counsel or professionals as well as your corporate counsel. It's really a team effort.
Well, that's always the mantra at our firm. Do it once, do it right. Thanks so much, Jason. Any comments or questions, feel free to drop them in the comments.